Gold, the ancient symbol of wealth and prosperity, has been making headlines in 2024 and early 2025. Its price surged by an impressive 27% last year. This surge took it to a record high of $2,790.07 per ounce in October. Several factors fueled this impressive rally. Inflation has been a key driver. When prices of goods and services rise, the purchasing power of paper money erodes. Investors often turn to gold as a hedge against inflation. They see it as a store of value that can preserve their wealth. Geopolitical uncertainties have also played a role. The ongoing conflict in Ukraine and tensions in the Middle East have created a sense of unease among investors. Gold, traditionally seen as a safe haven asset, tends to benefit from such uncertainty. The recent surge in gold prices underscores its enduring appeal. Investors continue to view it as a valuable asset in turbulent times. It provides a sense of security when economic and political landscapes appear uncertain. The relationship between gold and the US dollar is complex and deeply intertwined. For decades, the two were officially linked under the gold standard. This system, abandoned in the 1970s, directly tied the value of the US dollar to a specific amount of gold. Today, while that direct link no longer exists, the historical connection continues to influence market dynamics. The US dollar is the world's reserve currency. This means it is widely held by central banks and used in international transactions. Gold, on the other hand, is priced in US dollars on global markets. This dynamic creates an interesting inverse relationship. When the US dollar weakens, the price of gold tends to rise. This happens because it takes more dollars to buy the same amount of gold. Conversely, when the US dollar strengthens, gold prices often decline. Despite this inverse relationship, it's important to remember that the US dollar is just one factor influencing gold prices. Other variables such as interest rates, global demand, and supply dynamics also play a role in shaping gold's trajectory. While the US dollar undeniably influences gold prices, several other factors also play significant roles. Understanding these factors is crucial for grasping the complexities of the gold market. Interest rates set by central banks like the US Federal Reserve significantly impact gold prices. When interest rates rise, holding gold becomes less attractive. This is because gold doesn't earn interest like traditional savings accounts or bonds. Consequently, demand for gold may decline. Monetary policies pursued by central banks also affect gold. Quantitative easing, a policy involving injecting money into the economy, can lead to inflation. As we've seen, inflation often boosts gold's appeal as a hedge. The fundamental principle of supply and demand also applies to gold. Discoveries of new gold deposits can increase supply, potentially putting downward pressure on prices. Conversely, increased demand from investors or jewelry manufacturers can drive prices higher. The interplay of these various factors creates the dynamic and often unpredictable nature of gold prices. Looking ahead, the future of gold prices remains uncertain, subject to a confluence of economic and geopolitical forces. However, analyzing potential scenarios can provide valuable insights for investors. Inflation, a key driver of gold prices, is expected to persist in 2025. If inflationary pressures exceed expectations, gold's safe haven appeal could intensify, potentially leading to further price gains. The US Federal Reserve's monetary policy will also be crucial to watch. If the Fed continues lowering interest rates to stimulate the economy, it could weaken the US dollar, indirectly boosting gold. Fiscal policies such as government spending and taxation also warrant attention. Increased government spending, especially if it leads to higher national debt and inflation, could make gold more attractive to investors seeking to preserve their wealth. Geopolitical risks remain a wild card. The ongoing conflict in Ukraine, tensions in the Middle East, and potential flashpoints elsewhere could trigger safe haven demand for gold, driving its price higher. In conclusion, gold's future trajectory is uncertain, but by understanding the interplay of these various economic and geopolitical factors, investors can make more informed decisions about incorporating this precious metal into their portfolios.